All right, welcome everyone. This is another webinar brought to you by Jackson Securities. I'm your host, Jacob Pritchard. I've got with me here today, Dan Madden, CEO of Joyce Corporation. Dan, thanks for coming today. How are you?
I'm good, thank you, and thanks very much for having me. I'm much appreciated, and it's great to be here, and thank you very much for the interest of everybody who's also dialed in and logged in, and I hope you're all well and safe and surviving lockdowns wherever you may be. So yeah, good to be here, and I think I've got a good story to tell.
For sure. You know, we've been in touch a little bit over the last 12 months for sure, since making a bit of an investment, and yeah, you guys have been really punching through some strong numbers, and I'm sure a lot of the shareholders are pretty happy to see how things are going. But I know a lot of us are keen to probably see where you guys are going, some stuff about what you guys have done, and yeah, sort of what we can expect. For anyone that's watching today that isn't currently a shareholder, if you guys do have any questions, feel free to post them in the chat. We'll be answering them probably end of the webinar or even post the webinar as well. I know Dan's really active with his shareholders and stuff like that, so this will be really good. But feel free, Dan. We've got some stuff to go through. If you wanted to take us through this presentation, we'd love to hear it.
Great. Well, thank you very much, Jacob, and I'll do exactly that. We'll just make sure that we don't have any gremlins. So what I'll do is I'll just bring up the presentation first, make sure that's working, get the nod from yourself, and then we'll crack on. So we have done a dry run on this, so all should be fine. Bear with me.
No worries.
Okay, so you're okay at the moment for hearing me and seeing the presentation, I assume?
Correct. We've got a full screen view.
Wonderful. Well, I'll crack on then. So, as I say, thanks very much for your time. This is the investor presentation that was put up on our website with the annual results and accompanying the annual results. So I'll spend some time talking about the numbers, but also an introduction to Joyce for anyone who's not familiar with Joyce, and the businesses that are within the group as well. The disclaimer, obviously need to draw your attention to that. As I said, this is on the website, so on the ASX website as well. So please read that in your own leisure, and look at the accompanying results as well, which have more financial detail. So it's been a fantastic year for Joyce. I think we've got a great foundation to build this business, and I think we've got a really exciting journey in front of us. We're a well-established and long-standing ASX listed company. We're partnered with two quality Australian businesses in KWB and Bedshed, and I'll talk about those a lot more in the presentation. Our aim is to drive revenue growth in the group and to deliver above average returns through both capital appreciation and also through dividends. We've got a good track record of both, and again, I'll talk about that. And you know, most excitingly, we're very well positioned from our core businesses to provide a solid platform for growth going forwards. The way that we go about our business, we believe that working together with all stakeholders is the key to success, be that subsidiary or partnership businesses, customers, employees, franchisees and shareholders, and we're very focused on trying to develop strong relationships to be able to prosper in business together. So I'll take you through the structure of the group and how we generate the economic interest for Joyce shareholders. That's in Joyce Corporation. KWB is a leader in Australia's home renovation market for kitchens and wardrobes. We have 25 sites currently under the Kitchen Connection and Wallspan brands, which sit within the KWB group, and they're across Queensland, New South Wales and South Australia. We have a 51% majority interest in that business. We've held that now for a number of years, almost 10 years, not quite. And basically we account in our reports and in our annual report and accounts on a consolidated basis, but we have a 51% majority interest in the net profit from that business that is attributable to Joyce shareholders and flows therefore into Joyce Corporation and into the returns that we can distribute to shareholders. Bedshed is the other business within the group. It's a well-established brand. It's been established now for over 40 years, focused on bedding and furniture. We have a 37-store network, predominantly franchisee based. And again, we have a footprint over large parts of Australia. And again, I'll talk about that in more detail later on. So with regards to the economic interest from Bedshed, we have franchise fee income from those predominant franchisee operations. And then we have 4 bricks and mortar stores that just fill in complete subsidiary results, effectively 100% ownership. So it's also important to note that in addition to those businesses feeding into the results, and they're really the economic engines for Joyce, we also have a property on the balance sheet in Perth, valued at circa $5 million. And we also hold, obviously, 51% interest in an investment property held by the KWB Group. So we have a very strong balance sheet when you put that together with the, the group cash that you see there of $20 million.
Great.
So I'll talk a little bit about the operating results. First of all, a bit of a snapshot of the key results, and I'll talk about these in a bit more detail in the coming slides. But multiple highlights across the group for the last year. Very strong performance in all businesses. Record revenue of over $100 million. Obviously driven by strong demand for our products, but also through growth in our network, particularly in KWB. And again, I'll touch on that later when I talk about the KWB group performance. So very strong revenue, obviously driving good group net profit, and again a huge increase there in the net profit, and I believe a record net profit result as well. That's obviously led to a very strong uplift in the cash position, strong operating cash flow, 100% increase, group net cash, as I mentioned before, of circa $20 million. The net profit attributable to after tax, I should say, attributable to Joyce shareholders of $7.6 million. That's again another record and a significant increase from the prior year, and obviously that's fed into a 70% increase in the earnings per share to almost 27 cents per share. And that led us to basically pay a fully franked record dividend of 17 cents per share, again a 70% increase on prior year, and 63% of net profit after tax. I think it's also important to talk about the return of JobKeeper. We returned $1.5 million of JobKeeper. That's consistent with our values, something that we think was very important to do, and a decision that we made actually a lot earlier in the year, I think around February time, when the rebound in the performance was coming very clear. We had a strong first half and a strong second half. So we made that decision earlier in the year and made that payment a few months ago now. So looking at shareholder returns, we've seen a significant increase in returns to shareholders, both from dividends and from capital appreciation. You can see the share price graph there over the last year. That's more than doubled from $1.50 to circa $3.40, I think it is today. We actually hit $3.64 briefly a few days ago, which is a 100 million market cap. And that was one of the stated aims of the business, I think, within a 3-year window, probably about a year and a half ago now before I joined. So very pleasing to have been able to, albeit briefly, hit that 100 million mark, and particularly, having that driven by the core businesses and the economic engines that we have. The dividend there, you can see the prior year dividend was a 10-cent dividend, 17 cents fully franked in the current year. And importantly, with those well-performing operating businesses that have delivered consistent growth, and I think have very much the potential to continue to do that, that puts us in a position to deliver, what we believe to deliver a very steady increase in dividends into the future. And we've put out a range of 60 to 80% of NPAT as where we target to be. We paid out 63%. And I think very well positioned to continue that strong dividend return.
Perfect.
This is the financial performance metrics, the various profit margins that you can see there. We streamlined the company structure about 1.5 years ago by divesting Lloyd's online auctions. That was a business that was a bit more, it was harder to sort of predict the patterns in trading and the profitability of that, and I think it also detracted somewhat from the main drivers in the business, as I say, being KWB and in Bedshed. So that business was streamlined over 1 year ago now. We finalised the divestment of that early in the financial year just finished. So that was in the second half of 2020. That's really freed us up to focus on operational performance at KWB and Bedshed, and combine that with a strong cost of demand that we saw. We just had improved operational results across the board that you can see here. Increased revenue, increased profitability with regards to contribution margin and the EBITDA and EBIT. Both in dollars and in margins, and a 70% increase in the EPS there as well. So, as I said, very, very strong metrics, and I think most importantly, very well positioned to continue and take that forward, and I'll talk to you about that in some of the coming slides. I just draw your attention there on the EPS as well, that EPS comparison is on the continuing operations. So that's a like-for-like earnings per share and like-for-like profit from KWB and Bedshed, and obviously the Joyce corporate side of things, and excludes the Lloyd's online auctions, as does the revenue there, like-for-like revenue. So from the financial position metrics, we've significantly increased the strength of the balance sheet. I mentioned that earlier, $20 million almost of net cash. We're debt free. We in June 20 had a net cash of $5 million. Very low working capital intensity with the business, with a franchisee model, and with the KWB business model, which again I'll touch on a bit later. So streamlined operations and low working capital requirements have meant that strong demand has actually converted into a very strong operating cash flow, which has almost doubled from the prior year, $17 million in the prior year to 32 in the current year. Obviously the outflows there are what you'd expect with the lease liabilities, the tax and the interest, the capex, the dividends externally to Joyce shareholders, and of course we've got a 49% minority holders heavily involved with the KWB business and driving that forwards, and obviously taking dividends out from the consolidated group there as well. And that $3.41 million uptick during the year was the final payment on that divestment of Lloyd's. So that was a one-off payment there. And as I mentioned earlier, there's further strength in the balance sheet with the two properties that are held with the group that are circa $15 million in total.
No, that looks good.
So good results for the year, and a good healthy position to be in now with regards to cash and with regards to taking the business forwards.
Perfect.
So I'll talk a little bit now about the economic engines, the two businesses, a bit about the performance, and also just for those that aren't familiar with the group, and I think a little bit more information than we've maybe previously sort of talked about with regards to the business model and how the group works. Very consistent track record of growth with this business, and as I say, a leader in the home renovation market. It's kitchen and wardrobe solutions that we provide. It's what we say, from inspiration to installation. So it's giving the showroom experience, the design assistance for the inspiration for the kitchen, and then we manage that process through to the installation. So it's that do it for me market in the mid-market. 25 sites that we have, and the Kitchen Connection and the Wardrobe Connection and Wallspan brands. The storefronts are Kitchen Connection and Wallspan, with Wallspan being in South Australia and Kitchen Connection being in Queensland and New South Wales. and you'll see the split of the stores in a moment here. 25 showrooms, as I said, now 24 at the end of the financial year, 25 showrooms with Penrith recently opened, 7 in New South Wales. We started the business with stores in Queensland and South Australia, and then expanded around Queensland, and have over time headed effectively south on the east coast through Central Coast, New South Wales, and into Sydney. During the 2021 financial year, we opened 4 stores, Castle Hill and Artarmon, a more regional, Sydney regional, as we start moving into from outside the Central Coast and into Sydney proper, and they've been very solidly performing stores. It's been great to hit that market, and I think that notwithstanding what's happening with COVID at the moment and some of the timing maybe get interrupted, we've got a really good plan of opening new stores into Sydney into the current financial year and beyond. And in fact, we opened Penrith in July this year, and we've got another store, Belrose, that will open very shortly. But obviously, with the current lockdowns and restrictions, that timing is understandably just being held back a little bit. So when you look in the back at the performance and what we're planning here, it's around 4 showrooms per annum, steady state. Very successful track record of doing that. I'd anticipate another 4 this year, and no doubt 4 the next year. And then I'll talk a bit more about maybe the potential plans beyond that as I get into some of the other slides.
Perfect.
So from the results for the group, a record revenue of $90 million. That was a 34% increase on the prior year. We did $67.5 million from the 21 showrooms that we had in FY20. Those same 21 showrooms delivered $82.5 million of comparable revenue in the last financial year. Those new showrooms that we opened that I referred to generated about $7.5 million of revenue in the last financial year, and they were effectively on average open for just over half a year, because we opened them throughout the year. With the last one in Artarmon opened in May 2021. So that contributed to that $90 million revenue. When you look at comparable revenue or expectations for revenue into the coming year, those new showrooms will obviously be operating for a full year, and then we've got further showrooms that are being opened in this year. What's really pleasing as well, though, is that the order book was $107 million. So the revenue was increased by 34%, but the order book increased by 44%, showing the strong demand for the product and showing how well we hit those new markets in Sydney. So significant increase there from the past, strong demand from the product, new markets, we're being met very well in the new markets. And that order book exceeding the revenue last year by $17.5 million creates a good platform for strong revenue in the current financial year, because that excess of orders over revenue will need to get booked into revenue in the current year. And I'll talk about the business model cycle in a moment, and you'll understand why there is a delay from receiving the order when you're starting to do the design, and you've done the design, I should say, and you're working through the project, to when the project's actually finalised. There's obviously a period of time there, and it's the revenue recognition that occurs when we finally installed the kitchen. With regards to profitability, again, $16.3 million EBIT for the year in KWB. Excuse me, $11.3 million in the prior comparative. So a 45% increase in EBIT, which you'll recall is more than the increase in revenue. So the margins also improved during the year. And we've got a track record of doing that, and this is testament to John Burke and Chris Palin, who are the 2 key people driving KWB forward, and have been doing so right since our involvement with KWB. You look back at FY16, there were 13 stores. We've now got a currently 25 store footprint, so almost doubled. Revenue's gone from $40 million to 80. You can draw your own conclusions from your expectations for the current year, but it's not inconceivable that will hit the $100 million mark. And the EBIT obviously has also increased, as have the margins. So very, very solid performance, proven track record of growth. And I think that bodes very well for the remainder of the strategy to get into the Sydney markets and also beyond that. So a fantastic effort by those guys and that business. 120% revenue growth over 5 years.
Lovely. That's what I like to see.
So what I'll do now is just touch on the business model. It's the middle market, do it for me renovations. As I say, we're a leader in that home renovation market. We basically, offer the retail experience and run the retail experience, which is, website based and also showrooms. The showroom experience, obviously, via the website or via advertising, or most importantly, word of mouth, and just being placed in the right homemaker centres and people coming into the showroom. There is a showroom experience. There's probably around 11 to 12 kitchens in each showroom. We'll take the customers through the showroom, understand what they're looking for in terms of design, in terms of product range, and then basically from there we will send a designer out to the home. We have a computer-assisted design package so that there is autonomy in the way that we do that within the business, which obviously keeps the efficiencies and the accuracies. The designer will come out with the customer, design the kitchen, 3D design of the kitchen, and then we'll basically manage the product range to go into the kitchen through that, and then introduce a customer support manager who will basically take the design and product range selection and then manage the process with the customer from finalising the specifications of the components of the kitchen and the specifics of the design, and then take that through to basically the delivery of the kitchen, the installation of the kitchen, and the closeout of that. So it's that do it for me. It's about making it hassle free, and the model works exceptionally well. We have some subcontractors that help us into the process. We have strong relationships with 2 suppliers of the actual cabinetry, long-standing relationships with them. We have the factories that the suppliers have are within each state that we operate. And I think, testament to how well we manage this as a business model is that the kitchen reworks are, 1% of total revenue. So, we're managing that project. We're managing all those various touch points and all of those different components of having a new kitchen designed and installed. And at the end of the day, to sit at 1% reworks, which is a cost to our business, is testament to how well we manage that business. But most importantly, from the customer side of things, if we do that well, it creates referrals, and that is the mission of the business. And very, very pleasingly, that's borne out by the reviews that we have on independent review sites. Product Reviews, the largest independent review site in Australia. I think we're the only company with over 1,500 5-star reviews. So a very, very strong brand. And a strong reputation for excellence and a consistency of delivering that. And, we see that across the group and across the showrooms. So turning to Bedshed, a long-standing business now, over 40 years of high-quality bedroom furnishings around Australia, originally based out of West Australia. There's a very strong brand and loyal customer base. That is a predominantly franchisee-based network, as I mentioned earlier. A 37-store network with 32 of those being franchisee owned. 100% owned business within the Joyce Corporation group, and a consistent performer, and one that has delivered significant improvement in performance as well across the network in recent times. I'll talk about that a bit more in a moment when I get to the results. But in terms of the footprint of Bedshed, in orange there are the company stores. We have 2 in West Australia, and we have 2 in Queensland. It's helpful to have those to make sure that we have skin in the game, that we can roll out marketing campaigns, product launches, and we can really say to the franchisees, we totally understand your business model and the business. But primarily our model is on the franchisee side of things and the franchisee footprint. So we're focused on establishing a New South Wales presence. That strategy was sort of implemented just before COVID hit. A bit of an interruption through COVID, as you can imagine, but we got that running in earnest midway through last year with an e-store that was based out of Sydney, so we could establish a presence in New South Wales. We could sell product, we could have an online presence, and that obviously assists to then bring franchisees into Sydney as well. So we're developing a pipeline of franchisees for the current financial year. We have a number of franchisees ready and waiting to go. We have a couple of store locations that are set up, so we'll certainly have 2 stores opening in this financial year, and I would anticipate more. Again, with COVID, the exact timing of that is somewhat dependent on some of the restrictions, particularly as there are things like COVID relief when you sign on a lease. If you can't open the showroom, we don't really want to open the showroom and start paying lease if we get COVID relief if there are restrictions. So those sort of things will be on and off and fluctuate, I think, over the coming months. With regards to the results, again, you can see there over the last 3 years, this is the 100% owned return from the franchisee operations that you can see in that top graph. 1.5 million EBIT to 2.5 million EBIT in the current year, and improved margins as well as we increase the sales performance, but also as we increase the footprint. So that franchisee model obviously works very well in terms of increasing margins and returns as you grow that footprint, and that's our strategy with that. And as I say, we've got a lot lined up for Sydney there. So good revenue growth from the group. That $21.5 million revenue is for the company stores as well, as is that EBIT number of $5.9 million versus $1.8 million in the comparative year. And when you look at those EBIT margins, those EBIT margin comparatives are for the Bedshed group. So that's company stores plus franchisees. Low capital intensity and marginal cost to expand the network, and a focus on doing that.
Perfect.
Strong relationship with the franchisees. This is one of our recent fit outs and stores. I think it's Moonee Ponds. We've had 1 franchisee store up for resale in 9 years, and many franchisee partners in the network since 1980s. So in terms of the offering of Bedshed as a franchisee partner, we have a very, very good offering there and a very, very good reputation. And also, a focus on the advertising. We run the marketing and the advertising for the brand. The franchisees contribute to that, so it's pretty much at a minimal cost to us. There is a focus on really understanding the customer. Our last advertising campaign was a bedroom survey to understand the customer better. The current campaign is around the wide range of authentic and different experiences that people have in the bedroom, trying to really connect with customers. And this fits with what we try and do, which is really to aim to make a positive difference from our transactions and interactions with our stakeholders, including our customers. And then this recent advertising campaign as well, was met very well. It was nominated for awards, and the previous campaign actually won awards. So turning to the future growth and the next steps for the business, the near-term focus is certainly on the organic growth of the businesses, both KWB and Bedshed. We've got significant potential to expand the footprint of the KWB group and the Kitchen Connection brand. We've got plans over the next 18 to 24 months to expand into Sydney. 4 stores in the current year, and I would anticipate the same beyond that. Very, very well received in the Sydney market. I think with a couple more stores we'll be the largest home renovator within Sydney, and certainly, as I said, the reputation is very strong. Capital light business model with the way that those touch points work, and there are deposit payments from customers along the way through the design and the check measure with the customer support manager that helps us manage our working capital flow through that business. Strong focus on the increase of the network footprint, but it's also delivered, as I said, increasing margin and increasing efficiencies from the existing stores, as well as expanded revenue from the existing stores as well. And much the same with the Bedshed, with the franchise network expansion that I talked about into Sydney. We had also an online sales initiative in terms of e-commerce offering that we had ready just before COVID. Worked very well for us, particularly in Victoria. When Victoria went through the first lot of its lockdowns, we were well positioned to take advantage of that. But this is one of those areas that is just constantly evolving. You need to constantly be on top of. It's a growth area across the industry in terms of just making things easier for the customer, easier for the suppliers, easier for the franchisees, and something that we're continually working on that I think makes our product offering stronger, and obviously results in increasing sales and margins. So from a Joyce corporate perspective, with both of those organic growth from both of those businesses within the group, well positioned for growth, significant organic growth potential, low capital expansion costs, certainly relatively, strong balance sheet. We have a low gearing ratio with no debt, property assets. So we've got sources for growth funding, should we need that, or actually just to position ourselves to have that funding to take advantage of opportunities that may arise. And of course, a consistent focus on making sure that we minimise our corporate costs and are appropriately corporately structured. The strategy, as I mentioned on the organic growth, KWB 51% ownership is a cornerstone asset for us going forwards. Something that we are quite open to, obviously building on as well in terms of the position in KWB. That's obviously something that is natural, but there's no real comment to make on that other than it being cornerstone, and we see as I think it's pretty clear to shareholders the value of that asset. A disciplined approach to sourcing potential opportunities. We are trying to make sure that it's clear to investors and shareholders that we will be looking at adjacent sectors with a natural fit to the group's portfolio and to the group's expertise. We have a focus on new opportunities that have a pathway to ownership rather than being an investment company with sort of conglomerate investments, shall we say. We're more about focusing consistent with that KWB cornerstone asset approach on pathway to ownership and operations, and we are obviously attracted but not limited to relatively low capital intensity opportunities, which are consistent with the fact that we run that franchise model and the way that the KWB business model works. And of course, overriding all of that is maintaining good cash flow generation and access to funding and disciplined capital management. We certainly won't be doing anything rash or growth for the sake of growth in terms of acquisitions. So we employ with and partner with fantastic management teams. They are really the drivers of the growth and the performance of this business. We like to ensure that they're empowered and supported to drive the long-term earnings growth. I think it's very clear that you can see that from the results in the last year, and in fact beyond that. And as I said, our aim is about succeeding in business together and building strong relationships with our partners and all stakeholders to succeed together. So that pretty much runs to the conclusion of the presentation. There's a corporate directory here at the end of the presentation. This is, as I say, on the website. The latest shareholders when we published our annual report, and the management personnel and the board of directors. I won't take up any more of your time going through that. There may be some questions. I'll refer you to the references and the announcements that were out on the 31st of August as well, which gives more information on the numbers. And I'll close by saying thank you very much for your time and your interest.
Thanks very much, Dan. That was great. Obviously, more of what we've discussed and what we've seen. Definitely a great 12 months. I think for quite a few of the viewers watching today, even for people that aren't necessarily shareholders at the moment, you know, how you guys have handled since going into obviously the pandemic, where what we are at the moment, it's really refreshing. I think drawing your attention to the First Kitchen business and sort of the demographic nationwide. You guys have initially focused quite a few of the businesses in a few states, I guess, as you could say, as a bit of a proof of concept to work out some kinks, obviously in lower cost areas as well. And obviously now moving into some of the stronger, or I wouldn't say the stronger markets, but more of the highly value markets where obviously you guys want to go to. You guys have done a really good job to position yourself to, quite frankly, go quite aggressive into the future, which is really good. So really refreshing to see that. But look, I wanted to say initially from myself, shareholders watching, viewers as well, great 12 months from yourself and the Joyce Corporation. You guys have done really well. Now moving to, I guess, that strong performance, do you feel there's any key attributes that we should be aware of that we should keep in mind, I guess, when investing in Joyce?
Well, I think you know, the clean structure, the strong, you know, balance sheet that provides that platform for growth, and those economic engines in KWB and Bedshed that, you know, have, as you say, you know, they've proved the business model. KWB's proved you know, the expansion potential. It's gone from, you know, 13 to 25 sites, showrooms, I should say. You know, there's untapped in Victoria, there's untapped in WA, and just having that focus on doing what we do consistently in terms of growth and performance. You know, I think that's been the strongest you know, attribute, and will be for the near term. And of course, Joyce is well placed to take advantage of, you know, complementary opportunities and other growth opportunities as well. So, yeah, it's as you said before, you know, the proof of that model and the proof of expanding, you know, the showroom footprint is there, and we know we have good performance across the group. So, you know, very exciting times ahead.
For sure. I guess I'll move on to a little bit more of a pressing question that's a little bit more lighthearted. You know, a lot of people watching, investors, have probably seen over the last 12 months on the stock market, quite a few of these companies that aren't necessarily the highest in terms of profitability, and sort of trying to value the business. And I'm sure a lot of people have been watching Joyce as we have, and I think we spoke pretty early on, Dan, obviously when you came into the business, and obviously seeing the amount of profitability that's coming through, the revenue and the growth is really refreshing. I guess most investors are looking for strong companies that also provide not just growth but solid income. In a sort of a lighthearted way, is there a particular secret to you guys? Because yeah, typically on the ASX these days, you know, where we're not really seeing a huge amount of profit on other businesses, but huge amount of growth. But you guys are delivering on both, which is really nice to see.
Oh, look, I'm not sure that there is, you know, a secret. Certainly, I think it's important, you know, when talking to investors. I mean, part of it is making sure that the message is simple enough to be understood. You know, when you're in that sort of smaller micro cap, you know, range. We've got a consolidated entity with a franchise business, company-owned stores, the KWB business, which we own 51% of. We also had a previous business with the online auctions, and to pick that all apart and actually see the underlying performance of those economic engines can sometimes be challenging for investors, not because they don't have the ability to do it, of course they do, but actually the time for them to spend on understanding that. They've got a wide portfolio of investments and a wide range of things that they get asked to look at. So, one of the things we've really been focused on this year is actually just trying to simplify the story, make it very clear, allow those underlying businesses to show how they're driving Joyce, and how that translates into shareholders pockets. So the performance of the businesses themselves have just been doing what they do. There's a very strong focus here operationally from the operational management on efficiencies, on growth, and what really matters. And that's not really a secret. It's just, I think, needs discipline to do that. And I think that to maintain that discipline through the early outbreaks of COVID and the uncertainty that was coming through that, and to keep everybody motivated and focused on what we needed to do is an absolute testament to Gavin Colmsey, who's the general manager of Bedshed, John Burke, who's the managing director of KWB, and Chris Palin, who's the finance director of KWB and one of the part owners. They managed to keep everybody focused on what was needed, on what we were doing, and then that's just translated into strong performance in terms of growth and returns. When we've had the headwinds of the customer demand, which was somewhat unexpected, when COVID first hit, but you've got to be focused to take advantage of those opportunities. But even though that was somewhat unexpected, the fundamentals of the growth of the business and the growth patterns and the store performance, that's been there well before COVID. You can see that in those graphs.
Yeah, no, very well said. And I think I've said this before on a few businesses that we really like, but most companies have used COVID, and it's not any fault of their own, but as an objective to try and survive and preserve and everything like that. But you guys have appeared to turn it into an advantage, which is really good moving forward. And look, if I'm being honest, obviously with the performance that you guys have done in the recent times that we've had, it really sets up a good track record, obviously, for future endeavors. Obviously, there's always going to be challenges that come into the business, but obviously an ability to handle those challenges is really important. So that looks really good on your end, in which we're excited to see. Now, coming to you, obviously this has been a relatively new move for you. Nothing like last week or anything like that. But there's definitely been no shortage of things to do. What do you think shareholders should keep their eyes out for the next 12 months moving forward?
Well, I think, obviously the organic growth, the expansion of Bedshed franchisee network, which we've done a lot of work to position ourselves into Sydney, and particularly the KWB footprint expansion and the establishing into Sydney. I think that's going to, drive some solid revenue, and obviously the margins in that business have sort of speak for themselves. So I think, the next 12 months, that will be, a real focus of ours, but that really then positions ourselves for the longer term growth, beyond the next 12 months. We'll certainly maintain a focus on the longer term strategic opportunities, things that have a natural fit with the group's expertise, which I talked about. I don't anticipate, necessarily there's nothing on the horizon to happen in the next 12 months, and we're certainly not going to do an acquisition just for the sake of growth. But really sort of positioning ourselves beyond that organic growth, and making sure that whatever we do doesn't disproportionately detract from the value of what we have for Joyce shareholders. Positioning ourselves for that growth with that sort of that natural fit, and whether that's something that comes from within the business organically, new business opportunities, or whether it's something else that's opportunistic that has the right fit. That's sort of what I think we'll be turning our mind to, positioning ourselves for after the next 12 months. But the next 12 months, I think, is continuing to hit the Sydney market and to continue to focus on that expansion, and that I have no doubt will return good returns for investors in terms of positioning ourselves for the dividend and capital appreciation. And as you say, you know, for me, a lot of it is about, you know, consistency. It's about, you know, getting a clear message to investors around what the businesses are, you know, within the group, how they've performed, how they, you know, can be expected to perform, and then our job is to deliver on that and to build that reputation of doing what we say that we're going to do. You know, and getting that credibility, getting that expectation into the share price, and then building the credibility for, you know, the next steps of the business as well.
Yeah, I think that's a really good point that you've made on the outlook as well. And I think a couple more points that is quite exciting and encouraging as well is, you know, whatever comes up in the future, whether it's an acquisition or whatever it may be, if an opportunity does present itself, you guys are in a good position to take advantage of it. It's much better than saying, oh, we've got these plans in the pipeline, but looking at the balance sheet, it doesn't look like that you could execute if it did. So you'd much rather have the position to take advantage if there is opportunities, but not taking one for the sake of it, because that doesn't benefit anyone. But
absolutely, I think that's the other thing, is about making sure that there's that, you know, clear that there's that solid position and that solid foundation for dividends, so that they do come from that, you know, percentage of NPAT within that banding, and the business supports that, and then that can deliver the dividend growth. And that, and acquisitions aren't just, well, we're an investment company, so go and buy something else. You know, we're trying to, you know, send that message and set ourselves up, you know, and give that message that we're moving towards. It's about revenue growth, capital appreciation, you know, operational performance, and I think, you know, we're very well positioned to do that with the two businesses in the portfolio, and there's no need to rush and do something in a knee-jerk reaction that you see so many people do, quite often driven by ego or just short-term sort of desperation, the need to do something that ends up just destroying value a lot of the time for shareholders.
yeah, no, exactly right. And I'm finding, obviously, with our business as well, client shareholders, and you're probably hearing much of it the same, that, you know, the market's done really well over the last 12 months, but people are looking for, I wouldn't say certainty, but they're looking for something that, you know, they can trust, they can invest in for the future, and something that's obviously working. It's not just a flavor of the month. So, yeah, you guys have done really well over the last 12 months, and by no means have you guys overextended yourself either to get too aggressive and let the sort of the headwind get into you. So that's really good to see, and obviously we're really excited to see the next 12 months. I'm sure you are as well. And obviously, look, at the very least, we'll be looking forward to see how everything goes in the Sydney market. Obviously, it's been coming for some time now, so that'll be really good for the business. Now, we've had a few questions that have come through. There's actually quite a few. I'll probably have a few of those questions reviewed, and probably get Dan to answer those post the webinar, as a few of those have a little bit of detail that I think will probably take some care when answering those, so that should be fine. But those have all been received. Yeah, if you guys have any further questions post the webinar, I know Dan's really active with everything and really diligent with this. Feel free to email myself. There's inquiries at portjacksonsecurities.com. Even I know Dan has got an investor center as well, that he's always taking questions through. But I'll definitely get started on processing those questions for you. But from the first part, we're really excited for the next 12 months. Dan, thanks for attending today. Really appreciate it. And we're looking forward to see what you can do, obviously, moving forward. And we're looking forward to it.
Well, thank you very much for that, and thank you for everybody's interest. And with regards to the questions, please feel free to you know, reach out to me directly. We can organise a phone call. We can organise you know, a Teams meeting, something like this. You know, I will make sure that you know, I get back to you and that they get addressed. So you know, please do feel free to reach out. And thank you very much. Thank you very much, Jacob. Thanks to Port Jackson Securities, and as I say, thanks to all of you for listening.
Awesome. Thanks everyone for attending. We'll see you guys at the next webinar. Talk soon. All right.